Well, welcome to the most important thing. Howard, throughout his career, found himself saying to clients constantly, the most important thing is. And his book, he broke down into 20 chapters of the most important things and what he's learned. And today, we're going to get to discuss a number of those. And Howard, I remember, did I wander into your office or did you wander into my office?
You came to Citibank to see me.
Well, see the client, always going to visit the client
first.
And you were misguided in equities at that time, if I remember correctly.
I was a recovering equity investor.
So today we have a number of topics we're looking forward to covering. I'd like to start with the idea of failing to heed the lessons of history. You write that failing to understand the lessons of history more than anything else is what dooms investors to being victimized repeatedly, cycle by cycle. And I agree, and I actually believe that goes beyond investing in so many other things. You know, very few people do research or really reflect. Why do you say that? Why is that so important in investing?
Most things are, especially things involving people, are governed by cycles. And, you know, the economy cycles constantly. The life cycle of businesses. The markets are cyclical. And yet, repeatedly, people commit the mistake of thinking that trends will go on forever in one direction, that trees will grow to the sky, that something can be worth a little and that means it's going to go to zero. And these are when the biggest errors are committed by investors. As things get better and as prices rise in recognition of that, people extrapolate that. And people get more excited as things rise and want to buy them more, and people get more depressed as things fall and want to sell them more, which is just the opposite of what you should do.
And you touch base on a number of them. Let's take a look or talk about a couple. The Arab oil embargo.
Well, I mean, you know, before the Arab oil embargo, oil was selling for almost nothing. And the Arab oil embargo came along, and it convinced people that, to the contrary, oil was of infinite value. And it ran way up to a price in excess of what it should be. And the people who bought oil-related assets at the peak, despite the fact that oil is important and is available in limited supply, lost a lot of money for a long time because they got involved at too high a price.
The Nifty 50. I'm not sure everyone in the room remembers, Howard, the Nifty 50. We might be showing that we're over 30 by remembering.
Well, you have to go back, I guess it was about 40 years ago that the Nifty 50 had their demise. But when you and I got out of graduate school in 1969, the leading banks and the bank trust companies were the leading investors at the time. There were no boutiques and so forth. The bank trust departments, most of them emphasized something called Nifty 50 investing, which meant you took the 50 best companies in America, the fastest growing, Xerox, IBM, Kodak, Polaroid, Merck, Lilly, Texas Instruments, Hewlett-Packard, Perkin-Elmer, Avon, Coca-Cola, et cetera.
Walmart, McDonald's, et cetera.
And you bought their stocks regardless of price because they were the best and they were the fastest growing. And so they were a little expensive. It didn't matter. You wait long enough, they'll grow into it. And the official dictum, whether spoken or unspoken, at most of these institutions was that it didn't matter what price you pay as long as you bought the best. And the little hitch was that when I joined Citibank in '69, they were trading at 80 to 90 times earnings. And by '73, they were trading at 8 to 9 times earnings, which meant that you lost 90% of your money in the best companies in America. So that was a very painful lesson, probably my greatest learning experience. You know, experience is what you got when you didn't get what you wanted. But I learned a lot from it. And what it taught me is that risk and safety have nothing or little to do with asset quality.
You know, it's an interesting point, as Howard said. At this point in history, the money center banks, as we knew them, or the trust banks, it was a safe place to put your money.
Right.
And I think the weighted average PE into the early 70s was probably 66. And even a decade later, whereas Howard said you've lost 90% of your money, this really changed money management forever. Yeah. As Howard said, the idea of safety, if the large trust banks can lose, adjusted for inflation, 90% of your money buying the best companies, this really expanded greatly the money management business, the private money manager, the mutual fund business, in the sense that you thought you were safe and you weren't safe. And many of these companies eventually failed, like Polaroid, but many of them, as Howard said, remained among the greatest companies in America, as just their PE ratios reduced by 80%. Black Monday, 1987, Howard.
Well, again, you only have to go back 26 years to remember it. But that's the day that the stock market lost, I think, 26%. Now, you think of the market being down 3% and how panicked people get. Try losing 26% of your money in one day. There was not even an obvious candidate for what caused it. You had stocks that were too high based on too much optimism. You had people who had swallowed this canard of immunization, that you could protect yourself because you would establish a policy of automatically selling portfolio insurance, buying portfolio insurance if prices started to fall, and all you had to do was sell when they started to fall, except that the brokers wouldn't answer the phone, and it built on itself. So, you know, the lesson from that is that there's no such thing as a sure thing. My dad used to tell the story about the inveterate gambler who, always lost the rent money at the track, and finally heard about a race with one horse. So he went out and he bet all his money, and halfway around the track, the horse jumped over the fence and ran away. Not a very sophisticated joke, but the point is that there is no sure thing, and there's certainly no sure thing in investing, and when you hear about a sure thing, the best thing to do is run the other way.
And I think the other lesson of that period of time was interest rates were rising dramatically going into October of 1987. And if you fully understood that you can't have stocks continuing to go up and interest rates continuing to rise, which would require a greater discount on future earnings. And as Howard said, you had an anomaly in the marketplace. And so Howard and I grew up in the 1960s in business schools. You would have studied about how the market is perfect. Right. You know, it's efficient, it's perfect. And this period of time in 1987 always made you wonder, if the market's perfect, why is it trading 20% below the next day from the day before if it was perfect? And I think this gave you another rise, just like the 1970 period, particularly between 73 and 76, caused the explosion of mutual funds. It was this period in 1987 that began really the acceleration of hedge funds from traditional managers. Could you hedge? Could you find people to be short and long? Howard, what about the tech bubble? Let's move forward about another 12 or 13 years.
Well, the tech bubble was, Mark Twain said that history does not repeat itself, but it does rhyme. The themes rhyme, even though the details are different. The tech bubble was just like the Nifty 50. People believed that these were great companies, that they were going to change the world, and as a consequence, it didn't matter what you paid for them. And guess what? Collectively, they changed the world. The world has no resemblance to what it was 20 years ago, technologically, and yet, if you invested in most of those companies, you lost all your money.
I think this is a really important point I just want to emphasize that Howard has made. In the late 1960s, Merrill Lynch put out a report listing the 30 companies in the technology industry, and they were recommending the computer industry would increase 100-fold by the end of the century. Out of those 30 companies, within 15 years, only one was in the computer business. So they were 100% right in the enormous growth of technology in the computer industry. However, 29 of the 30 companies they picked were no longer either in business or in the computer business, I think, from that standpoint. And I remember, Howard, at that period of time when someone would want you to invest in a technology company, I said, well, it sounds interesting. Could we read it? And they would say, well, if you have to read it, you won't get a chance to invest because it'll be fully subscribed.
Sure.
It seems a little bit like the high-yield bond market today, doesn't it?
Well, I don't think it's quite as dramatic. And when you buy a bond, some guy, you know, I have to tell you that after the Nifty 50 thing didn't work out so well, is when I transferred to money management at Citibank from research, and I was put in the bond department. They wanted to keep me away from stocks. And I got a call in August of '78, and they said there's some guy named Milken or something out in California, and he deals with high-yield bonds. Can you figure out what that is? And the world didn't know. And so, you know, I met with Mike, and he explained to me that if you buy B-rated bonds and they survive, then all the surprises will be on the upside. If they survive are still the three key words. And if you buy high-yield bonds today at their paltry yield of 5% and they survive, you'll make 5%. And
well, you could get some upside, right? They could be acquired by a AA,
they
AAA?
could. Some good things could happen. And in fact, you know, most people are terrified of rising interest rates because it depresses the price of a bond temporarily. But if the credit is good, it still goes back to par when you get paid off. And in the meantime, the coupons are reinvested at a higher rate than you anticipated. So it's really not bad news. So you could do a little better than 5 if they survive. And the point is that nobody ever went broke making 5%. So you could wish you had more, but if it turns out, if high-yield bonds today turn out to have been a mistake, and I know there's been discussion at this conference of whether it is a mistake, it's not going to be a big mistake. It's not going to be a fatal mistake. And what you have to be aware of in the investment business is what carries you out. And it's not going to be credit-worthy bonds that you bought at a 5% yield.
I think Howard just made another really important point I want to maybe have you emphasize, Howard. In many ways, if you buy a long-term asset, it's really not the coupon on the bond, it's the reinvestment rate that's the key. And when interest rates spiked in 1974, insurance companies like Equitable Life Insurance Company and others wrote annuities where they were guaranteeing rates for a long period of time so you could compound your money. As interest rates dropped precipitously by 1977, they could no longer reinvest their money at the rates they were guaranteed, and they had a lot of economic challenges and eventually were acquired and merged. And I'd like you to go into that reinvestment rate a little bit, Howard, if you could.
Well, it's really, I mean, you have to be a bondo. You have to be a bond person to understand this.
Now, have you patented that name?
Most of them have died off.
Have you trademarked that name, Bondo?
Well, I think there's another guy who has.
Okay.
But everybody knows that when you buy bonds, you get the promised return through the coupon. And everybody knows that if you buy them at a price different from par, and they pay, they converge to par. And that those are two dependable sources of return. But most people who aren't bond specialists don't understand the importance of the interest on interest. And if you look at a long-term bond, like a 30-year bond, most of the return at the end of the day will not come from the interest or from the appreciation to par, but from the interest on the interest. So clearly, then it's a key moving part in the equation. And the question is, what interest rate do you reinvest the interest at? And when you buy a bond at a stated yield to maturity, the calculation assumes that the reinvestment will be at the quoted yield to maturity, but it doesn't have to be. And the truth is that whereas people are petrified to see bond rates rise, as I said before, because it depresses the price in the interim, it does facilitate reinvestment of the coupon at higher than expected rates of return. So it is actually a boon.
And the probability that you're going to be able to reinvest the money at that exact rate is extremely low, very close to zero.
So it's a somewhat illusory calculation.
Let's talk about the recent financial challenges and crises of 2007, 2008, Howard.
Well, it came about because, as I said, people ignored the cyclicality of things and came to believe that trees would grow to the sky and believe in permanent good times. The biggest single problem I was asked by the New York Times to write an article about the cause of the crisis. They asked a dozen people, and as you might imagine, they got a dozen answers. And my answer was an article called Too Much Trust, Too Little Worry. And basically, in the years immediately leading up to the crisis, 05, 06, and early 07, people came to believe that risk had been banished, and that the combination of the adroit Fed, which could fix any problem, the worldwide wall of liquidity coming toward us from China and the oil producers in the form of excess reserves, which would constantly buoy our stocks and asset prices, and the wonderful invention of Wall Street in securitizing, tranching, and selling onward, had eliminated risk and had sliced and diced it so finely and spread it so broadly that there really wasn't much risk left. So people stopped worrying about losing money. Risk aversion is the key element that keeps the market honest and sane. And when people are risk averse, they will do extensive due diligence. They will apply conservative assumptions. They will demand compensation for bearing risk. And all of these things are very helpful. But when they forget to be risk averse and then they drop their due diligence, they stop being conservative in their assumptions, they stop demanding protective covenants and adequate returns and risk premiums, and then prices get too high relative to reality, and that's when you get a bust. And that is what happened in 07, 08, in my opinion, more than at any time in my lifetime. It happened across the board. We've seen it before in different asset classes. In 88, there were 90 disk drive companies and so forth. So people that believed that the disk drive industry held the secret to sure riches. But prior to the crisis, they felt that everything was a way to get rich easy without risk, because risk had been banished. So that's what happened, and it's really an example of people ignoring the cyclicality of things. And let me just digress for a minute. When about 40 years ago, I learned one of the first of my important adages, and somebody told me there are 3 stages to a bull market. The first stage, when a few bright people realize that things can get better. The second stage, when most people realize that improvement is actually taking place. And the third stage, when everybody and his brother believes that things will get better forever. And so that third stage was reached in 07, as we've seen it reached a few times in our lives. And believe me, if you buy an asset where the seller and the other bidders believe that it's going to get better forever, you're heading for trouble. And that's what happened.
Well, I guess I would say, Howard, I still believe the 74-6 period was, more volatile than the recent period we went through, where interest rates doubled, stocks went down 50%, et cetera. And as you and I have discussed over the years, I would say that when you look at these financial crises, they're really related to 4 or 5 things. One, leverage. As companies increase their leverage dramatically, financial institutions leverage 40 to 50 to 1 with the idea that that's how they're going to get rate of return.
And investors leverage.
Investors, as you said, leverage. The belief that there's some special quality of real estate. And as we reflect on this period of time, the area that Howard has particularly specialized in his firm in corporate or company obligations, I don't think $1 was lost in the CLOs versus substantial losses in the mortgage. The belief that these things were AAA was a fallacy. Third, I would say ratings, the idea that you're dependent on ratings, and obviously Howard, the value that your firm has created is doing its own research. Risk, it's another area that you really cover in the book. And you've devoted it into three parts, kind of understanding it, recognizing it, and controlling it. Let's walk through how you look at risk and how investors, as you've pointed out a couple times here, commonly misjudge risk.
Sure. Well, number one, most people equate risk with low-quality assets and safety with high-quality assets. And they still do. I mentioned the Nifty 50. High quality, people thought, you know, there's an old saying, you can't get hurt buying IBM. And we documented you lost 80 to 90% of your money. On the other hand, what about low quality? Is that a source of risk? You know, when I got started in high yield bonds back in '78, I looked up in Moody's, what does it mean to be single B? And Moody's defined a single B bond as follows, quote, fails to possess the characteristics of a desirable investment. In other words, low quality asset can't be a good investment. Well, is there no price at which a low quality asset becomes a good investment? You know, if we went out after this session to the parking lot and I said to you, I'd like to sell you my car, would you like to buy it? And let's say you like my car and you have money and you need a car. Hopefully there's one question you would ask me before saying yes, and that's what's the price? And here Moody's was saying that a B-rated bond is a bad investment. Well, what about at 75 cents on the dollar? What about at 50? What about at 25? Is there no price? And so this is the kind of herd error that you can take advantage of. So risk is not quality. And you know, most people believe that as something is rising in price, that means that people think better of it, it's less risky. Well, I think that when something rises in price, it becomes more risky. Most people believe that the things that everybody think are risky are risky. I think the things that everybody thinks are risky are safe because their aversion to it forces down the price to the point where it is safe and potentially lucrative. What is the riskiest thing in the world is the belief that there's no risk. Risk is perverse. That's the important thing that's what the chapter in the book talks about, it's the perversity of risk. And it's the belief, like in '07, the belief that there was no risk is what made the world risky. And in late '08, after Lehman Brothers melted down, the belief that there was no potential future is what created a great potential future.
And I think to follow up on what Howard said here, the rating agencies keep the same rating on a security, whether it's 100 or 25. It might be a AAA at 25. It might be a single A at 50.
And by the way, the rating agent, you know, you and I should have a word for the rating agencies. I was speaking at Wharton one time, and somebody said to me, "What is the role of the rating agencies in this process?" I said, well, the role of the rating agencies is to be wrong, because it gives us something to game against. You know, I don't know how many people in this room know how many corporations are rated AAA today, but the answer is 4. How many mortgage obligations were rated AAA in the mortgage wave? Mike tells me 16,000. I believe him. So is it possible that after 100 years of economic history, our economy only created 4 AAA rated companies, but in a few years, Wall Street was able to create 16,000 AAA rated mortgage obligations? And it was probably the greatest opportunity to make money in a lifetime, in a short period. You know, people say to me, what is my greatest regret? And I always say my greatest regret is that I wasn't John Paulson. You know, his little mutual fund made $16 billion that year on the mortgage trade.
Well, Howard, you had the chance to buy many bonds at 10 cents on the dollar.
Yes, this is true.
20 cents on the dollar that have already paid off at par. So,
yeah.
And in probably, you know, large volume. Let's talk about one of your favorite chapters in the book, knowing what you don't know. Okay, overestimating what you're capable of knowing and doing the extremely dangerous things rather than working within your limits. Why don't we talk about that?
Well, look, I think, Mike, and I know you agree, that the investment world is a world of excess testosterone, where people believe that they have to prove.
Well, we have a little, women play a much larger role now.
Well, they may have it too.
Okay, good.
But people believe that it's their job to know what the future holds, that you can know what the future holds, that they do know what the future, or if they don't know what the future holds, that they have to act like they do, because if they admit they don't, they'll get bounced. And I believe that you can't know what the future holds. You can figure out which outcomes are the most likely and how likely they are, and what alternative outcomes are likely to happen and how likely they are, and which extreme outcomes could happen. And you can kind of sort the world into a probability distribution. And I think the best people in the world are the people who are best at visualizing that distribution of possibilities. But there's almost nothing in the world which is determined. Everything is uncertain. And Elroy Dimson, who's a professor at the London Business School, says that risk means more things can happen than will happen. There are very few things of which only one thing can happen. And yet people tend to invest under the assumption that they know what's going to happen. And I think that this is one of the biggest mistakes you can make. You know, Mark Twain said, it's not what you don't know that gets you killed. It's what you know for certain that just ain't true. And I think this is very, very important. There's nothing wrong with saying, I don't know, and acting accordingly. And most people never get killed in that way. The real danger is in saying, I know, and acting on the assumption that it's correct, and then being wrong. You know, if after this session, you and I are going to drive to Barstow, and I
could, but first I have to go to Africa.
Okay. Well, but if we say we don't know how to go, then we're going to get a map, use GPS, ask directions, and drive slowly to make sure we don't make a wrong turn. But if we assume we know, we don't get a map, and not just because we're men, and we don't ask directions, not just because we're men, we don't use the GPS, and we drive fast because we're confident. And if it turns out you didn't know, then you end up in Africa. So the point is, I think that it's very important to know what you don't know and to act accordingly and to respect what you don't know. And the point is, you don't have to know the future to be a good investor, and especially the macro future. You know, today there's a great belief that macro rules the markets. And so you should figure out when the Fed is going to let interest rates rise and stop stimulating, what's going to happen in Europe in terms of its staying together and how it bails out the peripheral countries, and how low China's growth rate goes. That these things are the things that are going to move the market, and so that's where you should spend your time. Now, the interesting conundrum is that in the short run, they are the things that are going to move the market, but I believe you can't know them. And if you can't know them, then you're wasting your time trying to know them, and you should know the knowable. And the knowable consists of getting an advantage versus other investors with regard to companies, industries, and securities. And these are the things where hard work and skill will pay off, and these are the things you should spend your time on.
Now, Howard, to follow up on the point you're making, when you go to school and business school or other things, you constantly use regression analysis. And so, and underlying this issue that Howard's just pointed out here, that regression analysis tells you what the future is based on the past.
Right.
And if you remember, Howard, back in the 70s, a company that had been paying dividends for more than 120 years, Singer Sewing Machine.
Yeah. Sure.
So they were rated single A, and they sold bonds into the marketplace in January of 74 in this example. And obviously, if you looked at the past, Singer had growth. But the future, as Howard identified here, the risk, well, it's the emancipation of women in the 1960s and 70s. Possibly women wouldn't be home sewing as much as they were. And maybe the future for Singer would not be the same as the past. And as a result, those bonds traded at 35 within 12 months as people discovered that. And I think this point, I just want to stress this chapter, knowing what you don't know, is so important, because if you're interested in the financial service industry, what Howard just said, it isn't losing money where you thought you were taking risk. It's losing money when you didn't think you were taking any risk that really changes behavior. And it was the Nifty 50 in the 70s that really changed that it was not safe just leaving your money in the trust. And it was really this period of time in the late 80s, and again, that what you thought was safe, you lost money in AAA bonds, you lost money in money market funds, whatever it might be. And that is really what changes behavior, because you were trying not to take risks. Let's pick another one of my...
Can I tell you one thing about risk? Back around 81, I was interviewed by something called Financial News Network, which used to be on TV. And they said to me, how can you invest in junk bonds when you know some of them are going to go bankrupt? And for some reason, the answer came to me. And I said, look, the most conservative companies in America are the life insurance companies. How can they insure people's lives when they know they're all going to die? But how do they do it? Number one, as you say, the key, it's risk they're aware of. They know they're going to die. It doesn't come from, oh, we had somebody die. Number two, it's risk they can analyze. So they have you get a physical. Number three, it's risk they can diversify. They don't only insure people on the San Andreas Fault, or only skydivers, or only smokers. And number four, it's risk that they can get well paid to take. If they figure you're going to die at 80, then they sell you a policy based on the assumption that you'll die at 70. And if you die at 80, they come out okay. And if you die at 70, it's a bonanza. So the point is that if you understand risk and you're aware of it, you can price the asset right and you can get a bargain.
So let's pick up, Howard, on this point you've just made, maybe paraphrasing it. A life insurance company has done their analysis, no different than you do credit analysis, and attempted to figure out what your life expectancy is based on statistics. As we improve our treatments, your life is extended. So if I've sold you life insurance, it's a real positive for a life insurance company because you're living longer. If I've given you an annuity that's going to pay you as long as you're going to live, then I'm on the other side, and then I'm going to pay you longer than I expected. But they're attempting to analyze what they conceive as risk. Let's pick another of one of my favorite chapters, Howard, having a sense for where we stand.
Well, that goes, Mike, to my belief that the future is unpredictable. There's nothing that can be proved about the future. We can't know the future in a macro sense. At our firm, we don't run our investments based on predictions for the macro. But that's a challenge, because what is investing? It's making decisions with regard to the future. It's positioning a portfolio to make money, hopefully superior money, in the future. So if your job is dealing with the future and you can't know the future, does that mean it's a wreck? And what I believe is that we never know where we're going, but we sure as hell ought to know where we are. And we cannot very helpfully know the future, but we can very helpfully understand current conditions. And what we try to do is what I call take the temperature of the market and understand the climate and assess primarily the behavior of the market participants, and that tells us what to do. My favorite quote is from Warren Buffett, who said, "The less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs." If other people love securities and can't imagine a way to lose money, then we should be terrified. And if other people hate securities and are terrified of the future and can't figure out a way to make money, then we should turn aggressive. We don't have to make a guess about the future in order to figure out how to position our portfolios. The tips that we get from observing the behavior of others and inferring what it means, that's enough.
I think this area could be seen on each of you that operate your operating companies, the point that Howard has made here. You know, if we go back in history, when Lockheed went into Lockheed Martin Marietta today, the commercial aircraft business, they could have picked GE to make their engines. They could have picked United Aircraft, but they chose Rolls-Royce. And one of the things that did and why they're not in the commercial aircraft business today was they discovered that they couldn't deliver their airplanes after Rolls-Royce went bankrupt. The airlines would not take their airplanes without engines. They were really surprised. And therefore, Lockheed was taking more risk by choosing a firm that was far weaker financially, and it had problems, then Lockheed had problems. And so many people that are building projects sometimes farm things out to subcontractors who then have issues. So risk can be passed down in an operating fashion, or as Howard said, in a portfolio. Let's talk about something that you often don't talk about when one talks about investing, and that's luck. Okay, appreciating the role of luck.
Well, the future, I mean, I think this is one of the most interesting topics. The future does not exist. The future is only a range of possibilities. It's not like there's some event in the future which is going to happen and that event exists in prospect today and it's predictable. There are lots of different things that can happen in the future. And given the fact that, as Dimson says, more things can happen than will happen, we have to understand that in large part, outcomes will be governed by luck and randomness. And there's an excellent book called Fooled by Randomness, written by Nassim Nicholas Taleb, which talks about the world in this indeterminate sense, and which, number one, if you read it, I think you'll be convinced that you, number one, don't know what the future holds, can't know what the future holds, shouldn't behave as if you can know what the future holds, and maybe more interesting, it will convince you that when you look at past events, you see, there's a tendency to say, well, yes, the future is indeterminate, it hasn't happened yet, but the past is over. That's history. And we know what happened, we know what to make of it. But the point is that the past was in large part determined by luck. And Taleb uses the example of the famous investor. And our industry is full of people who got famous for being right once in a row. When you couple that fact with the fact that much of history was the product of randomness, then you understand that history may not tell us anything. You look at the record of an investor who had a great year, it doesn't mean he was a great investor. It means maybe he got lucky. Maybe he took an outrageous position in his portfolio and was favored because something that had no right happening happened. We have a mutual friend, Bruce Newberg, and Bruce and I play a lot of backgammon. And he often hastens to point out that improbable things happen all the time. And likely things fail to happen all the time. So when you see a result, you don't know if it was luck or skill. until you see a long string. If somebody can make decisions, 100 decisions, and get 70 of them right, or 80 over a long period of time, then you can start to believe that it's skill and not luck. But you know, I think that there are 3 ingredients in success, Mike: aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, you don't need much skill. But you know, in the long run, luck, and especially the luck of good timing, gets washed out, and that's when skill comes to the surface.
Let's take a look at this concept of luck, and Howard talks about randomness. President Clinton decided to run for office, and George Bush, the first, had over 80% approval rating. But Ross Perot was also running, and if Ross Perot had not run, quite possibly George Bush would have been reelected the president. So that event, when you look at it in history, says, well, maybe someone else had run for president and it changed the course of history dramatically.
I've got one for you.
Or I just wanted to finish the presidential.
I think we're going to the same place.
And then Ralph Nader ran
Mm-hmm.
when Al Gore was running, or Al Gore would have been president of the United States. So the fact that there's an individual who does not have any chance to win, but for whatever reason, and you might have said that Ralph Nader would have preferred to have Al Gore president, but if he preferred to have Al Gore president, why did he run for president? And whether it was 1% or half of 1% or 2 or 3%. And this issue in history, I think, as Howard says, when you go back, you don't always look at the footnotes as to what occurred in history that set that thing in motion.
Well, Taleb talks about what he calls alternative histories, which is the other things that reasonably could have happened, but didn't. And when you look at even history, you have to be aware of that possibility. Was Alexander the Great great because he was a great general and strategist, or did he say, I'm sure it's going to rain, and it rained, and that made him a winner? In which case, could he do it again? You know, the example I was going to use is in this last presidential election. I believe that 16% of all people said that the response to Hurricane Sandy was the most important thing in determining who they would vote for. And of course, presumably that means they voted for Obama, because you couldn't vote for his opponent based on the Sandy, and Obama won by 3%. So does that mean that if Sandy hadn't happened, Obama wouldn't be president? On the numbers it does. It's probably not accurate, though.
I would say, though, that there's another saying, Howard, and the harder I work, the luckier I get.
This is true.
And so if you're a bridge player and you can count cards and you can understand, you can have a really high probability of figuring out what's in each person's hand without looking at that. And by doing work, there are some things that we do know for sure. In demographics, we know how many people are going to be 25 a decade from now. Until we figure out how to age faster, we have a pretty good understanding when California, for example, where the #1 ethnic group will be people with Latin American ancestry and so on. So we do have knowledge that can put yourself in a position where you can take in a position to get an outside rate of return, or to be lucky because you have done your homework and you've positioned yourself. And there's so many things. You know, I might have a little different opinion, Howard, and I feel there's very few surprises. On the margin, the surprises make all the difference.
Yeah.
But there aren't that many surprises if you sit down and think about what's occurring. We know that China will be the world's largest economy. We don't know when.
I thought you did.
No, I don't know. I don't know, Howard. I don't know whether it's August or September.
Okay.
But, you know, I don't think you ever joined us, Howard, but many years ago, Norman Lear used to have these sessions where everyone got to bring their expert on the world. And I was brought as one of the experts, but I was so fascinated by the scientists from Caltech. And his investment strategy at the time, this is in the 70s, was to short all the casualty company stocks because he had figured out there's going to be this major earthquake that was going to destroy a high percentage of all the real estate in Southern California, and it would bankrupt the casualty companies. So I just asked him, when's he leaving California? And he told me he's not leaving, you know, till 1978. I said, are you sure it's not going to happen in 77, et cetera, and you're going to be around? So there are things that people say that, you know, are relatively absurd, but there is an argument here that hard work, hard study, and I think you would agree with that, Howard, is the fundamental nation to putting yourself in a position to, quote, be lucky.
Know the knowable. But it's not just working hard, it's working hard in the right places, working hard on credit research. What if when you had gotten out of school, out of Wharton in '69, rather than doing what you did, you would have been approached by a recruiter who said, Mike, we've figured out that in the NFL we can predict, you know, I work for a bunch of gamblers, and we figured out that you can predict the outcome of NFL football games if only you know which team will win the coin toss. So we're going to give you a Cray supercomputer, you remember those, and 100 PhDs, and a big research budget. And all you have to do is predict the coin toss. And if we know that if the coin is fair, that would be a waste of time. So some things are a waste of time, and some things are knowable. And yes, hard work and skill will pay off on the knowable and not the other.
Let's turn our attention to something that's very important in building your organization or any organization, and that's human capital. How you attract, how you retain, how you build a culture, because it's a culture of investing also, right. Howard. Talk to us a little bit about the building of Oaktree.
Well, our approach, number one, was to set out our creed so that everybody who works there knows what we stand for and knows what our guiding beliefs are and what's expected of them as a result, number one. Number two, we always stressed having a harmonious environment and teamwork. So people at our firm do not have individual balance sheets. You know, there are a lot of institutions where you run some money, and if you make money, you get a bonus, and if you don't make money, you don't get a bonus, and as they say, you eat what you kill. And it's all on the individual then. We like to have an organization where people are incentivized to pull together. So everybody gets paid on how their team does and how the firm does. One of the important components was to de-emphasize individual achievement and even, to some extent, team achievement, and bring in the element of the firm. There are a lot of people in our business, in the alternative world, the private equity and so forth, who share in the carry on their funds if the fund does well, but it's relatively rare to share in the overall profitability of the company. We, you know, from the start, our motto was that we wanted to own less and less, the founders, of a company that was worth more and more. And we thought that's what would make it worth more and more. And so, you know, there were 5 of us the day we started. At the end of the first year, we made it 18 who owned the firm. 2 years later, 26, and so forth. So by the time, that was 95. By the time 07 rolled around, we were owned by 85 people. Today, we're owned by 170 people.
Not counting the public share.
Not counting the public. So, you know, we've always thought that that was very important. So I would say, you know, and the book, The Most Important Thing, stemmed really from a memo I wrote in 02 called The Most Important Thing, one of which said that you have to, if you run an investment firm, or I think any company, you have to stand for something other than just making money. You have to stand, if you run an investment management firm, you have to stand for something other than assets under management. What do you stand for? So I think it's a great help to enumerate what you stand for, to recruit team players whose personalities can be consistent with your creed, and then to try to have a harmonious environment in which the emphasis is on team behavior.
I want to go back, Howard, to something you had said a little while ago, because I think it's important here. Whether you were going to have a supercomputer to figure out whether it's the coin tossed or how to bet on games, in building your company and standing for something, one of the advantages of being an investor or financing, if you stand for helping build great companies, putting capital behind good companies, you're obviously dealing with the prosperity of our society in so many ways. And so for me, it was really a choice of how do we empower individuals, how do we get capital into the hands of people with ability, and with that, entire societies will benefit. And I think, your firm has particularly been focused on how do you rebuild companies, not just how do you invest in them originally. How do you bring the skill set to that? Obviously, your partner, Bruce Karsh, today is the chairman of Trivium, right, which was a company that had the wrong capital structure and the wrong strategies today. And so when you're looking for a person today, what are the qualities you're looking for in a person that someday might be a partner of Oaktree?
Well, I think a constructive attitude. As you say, especially in the distress area, we make money by returning companies with the wrong capital structure to viability through restructuring.
Or the wrong management.
Or the wrong management. That's not our main emphasis, but yes, that's another way to do it. And we look for people who want the win-win solution. I believe that if you look back to 2007, one of the ways we got in trouble with the mortgage securities that you were talking about before is that the prevailing ethic was that the boss came into the office of these 5 PhDs from MIT and dumped a bunch of mortgages on the table. He says, here's a bunch of mortgages that were made to people who didn't give their income or their balance sheet. See how high a rating you can get. And so they tried to slice and dice it into mortgage-backed securities, and if they could, on average, get an A, that would be good. On average, AA, that better. AAA would be great. Nobody ever said, yeah, but is it right? Is this pile of junk really AAA? Nobody ever said it. They played a game of ratings maximization. And I think that it's important, for example, when you restructure a company, to put it out with a capital structure which is viable for the long run, not just one which will maximize your profits today. And we want to have people who want to contribute to that process.
Howard, I'd like to ask you one more question before we close today. And we had 40 or so CEOs of great companies in America sit around the table, and everyone today talks about succession, who's your successor, et cetera. And whether it was Mark Benioff or David Simon or Tillman Fertitta or Steve Bird and others, or we could have used Steve Jobs and a bunch of others. At the end of the day, that meeting is there wasn't necessarily a substitute. Okay, trying to get, as you would say, out 2 or 3 standard deviations. There are people that are more outstanding, and you don't necessarily replace them. You built your firm with you and Bruce and your partners a long time ago. How do you view now as a public company succession from that standpoint?
I think the key is it doesn't have to be a one-for-one substitution. You want to find people who will perpetuate the company, who will continue, in our case, to put excellence above quantity, and the clients ahead of their own interests in the short run. In recent years, a lot of my contribution has been in writing the memos and writing the book and speaking about these things. My so-called successor doesn't have to do those things. He or she can contribute in other ways. I think the thing to keep in mind is again, the values and the quality, and not insist on following a preordained roadmap. Success, as you and I have seen, we've dealt with a lot of successful people over the last 35 years together, and they're all kinds of people. If I said to you, Mike, what's the secret to be successful? We've seen lots of different people of different stripes become successful. And many people who run great companies are different kinds of people running different ways. There are lots of ways to skin the cat. but it has to go down to quality, culture, and it doesn't hurt to be smart.
And I think the other thing, Howard, is the culture is so important, and also not necessarily trying to hit a home run.
Right.
So that as you started out our discussion today, even if it's not great, it's good.
Right. Well, good is good enough.
That is correct. And Howard, I want to thank you for your great contributions.
Thank you.
And the most important thing.